against inflation and market volatility. Do you think shopping centers still are a strong investment in today's climate with inflation, interest rates, and the cost of capital?
Well, the good part of inflation, I guess, would be that your replacement. So if you already own property and you bought property for below replacement cost, which is essentially all in our entire portfolio would fall in that category. If there is a lot of inflation, your cost to build new property just goes up that much more. So that in itself kind of creates a little bit of a moat in that you're not going to get a lot of new product coming online competing with your product if that's the case. So if your supply growth is limited and your demand continues to grow up at a steady pace, then that helps out everyone that already has property. So I think when you look at it from that side, that's pretty interesting. When you look at it from the side of interest rates, usually if there's a lot of inflation, assuming that the unemployment rate is not too high, the natural response from our central bank, from our government, would be to increase interest rates to try to, temper that inflation. Which is interesting because when you increase the interest rates, historically, I don't know about historically, but I think there is some loose correlation of having the cap rates also go up because no one likes to buy with negative leverage. So if the cap rates go up, then we're able to buy more property at a little bit higher cap rate, higher yield, and so that's good for us also. That hasn't been the case the last couple of years. So it's been a little bit of a strange capital markets period, but I think that may come to fruition this year. And then when it comes to inflation hedges through the income stream itself, meaning that the tenants, what the tenants are paying, the great thing about retail is that these are triple net leases. So meaning that when you're billing the tenants, you're billing them the base rent that does not include the expenses. And then you're billing the expenses separately. You're billing the real estate taxes, the insurance, and then the CAM, all as separate line items. So if those items go up because of inflation, then you're able to pass those expenses through to the tenant, who then needs to increase their prices as well, because I'm sure that they would be experiencing inflation not just from rent but also from their cost of goods sold. So that inflation hedge is very interesting. You do have to be mindful because some of these national credit tenants, and there's some very desirable tenants, they're going to put caps on the increase in their CAM, or they might have a fixed CAM that doesn't increase at all. They might have a fixed or no increase in their base rent. So when you're looking at a rent roll, if you have too many of those tenants that have fixed CAM or fixed base rent, then you may not be able to take advantage of inflation until you have the rollover opportunity that allows you to bring those rents up the market. So like a great example would be some of the bankruptcies that have happened in the past few years. Kmart and Sears have been around for 50 to maybe 100 years, and I think that some of those leases, because I remember I had a Kmart lease. I mean, there's no rent increase for 47 years because they locked in that rent when they signed it in the 1990s, and they said that's it. This is the rent, no increases. And it's like sometimes you want to have some of this turnover to be able to access the ability to bring your rents up to market and take advantage of that inflation.
Yeah. So
down in the desert heat, bright lights calling from the Vegas streets, name tag on and a game face tight, here to deal, here to